Welcome to Read in Minutes. Here's a short summary of the book, When Genius Failed: The Rise and Fall of Long-Term Capital Management by Roger Lowenstein. If you enjoy it, then please hit the like button and don't forget to subscribe to our channel. Now let's get started. Roger Lowenstein's When Genius Failed is a gripping account of the dramatic rise and catastrophic fall of long-term capital management, LTCM, a hedge fund that was once considered the pinnacle of financial intelligence. LTCM was founded by some of the brightest minds in finance, including John Meriwether, a renowned bond trader, and two Nobel Prize-winning economists, Myron Scholes and Robert Merton. The firm was built on the belief that mathematical models and complex financial theories could be used to minimize risk and generate enormous profits. However, despite its elite team and sophisticated strategies, LTCM collapsed in 1998, nearly bringing down the global financial system in the process. The book serves as a cautionary tale about the dangers of excessive confidence, the limits of mathematical models, and the risks of leverage in financial markets. The birth of LTCM. The origins of LTCM can be traced back to John Meriwether's career at Salomon Brothers, one of Wall Street's most powerful investment banks. Meriwether had built a reputation as a brilliant trader, particularly in the bond markets. He believed that finance was not just about intuition or experience, but could be approached with scientific precision. At Salomon, he created a specialized trading group that relied on quantitative models to identify market inefficiencies and make profitable trades. His team was incredibly successful, and he became one of the most respected figures in finance. However, Meriwether's time at Salomon Brothers ended in scandal. In 1991, the firm was caught in an illegal bond trading scheme involving U.S. Treasury securities. Although Meriwether was not directly responsible, the scandal tarnished his reputation, and he left Salomon in 1994. Determined to rebuild his career, he decided to start his own hedge fund. He recruited some of the smartest minds in finance, including Scholes and Merton, whose work on options pricing models had revolutionized financial markets. With their expertise, Meriwether believed that LTCM could create a nearly risk-free investment strategy. LTCM officially launched in 1994 with $1.3 billion in initial capital, an astonishing amount for a new fund. The firm's strategy was based on fixed income arbitrage, which involved exploiting small price discrepancies in bonds and other financial instruments. They believed that these discrepancies would eventually correct themselves, allowing LTCM to make consistent profits. Their approach was highly sophisticated, relying on complex mathematical models and historical data. Investors were eager to participate, and LTCM quickly became one of the most prestigious and secretive hedge funds in the world. Early success. LTCM's early years were marked by spectacular success. The fund's returns were consistently high, and many in the financial industry saw it as unstoppable. In 1995, LTCM achieved a 28% return. In 1996, it nearly doubled its investors' money with a 59% return. In 1997, it delivered another 25% return, reinforcing its reputation for being virtually infallible. These results convinced many that LTCM had discovered a new way of investing that minimized risk while maximizing returns. Banks and institutional investors lined up to lend money to the fund, offering incredibly favorable terms. LTCM's secret weapon was leverage, borrowing vast sums of money to increase the size of their bets. At its peak, the fund controlled over $100 billion in assets, while having only a few billion in actual capital. This meant that even tiny price movements could generate massive profits. However, it also meant that small losses could turn into catastrophic failures. Despite their success, LTCM's traders and managers became increasingly overconfident. They believed their models could predict the future with near certainty, and they started taking on even riskier positions. They expanded beyond bond arbitrage into equities, emerging markets, and even complex derivative contracts. They assumed that financial markets were rational and that their models would always be correct. But financial markets are often driven by human emotions, panic, and unpredictable global events, something their models failed to account for. The Russian financial crisis. In August 1998, LTCM's world began to unravel. The Russian government, facing severe economic troubles, suddenly defaulted on its debt, meaning it refused to pay back bonds it had previously issued. This event shocked global financial markets, causing widespread panic. Investors rushed to sell risky assets and buy safer ones, leading to massive shifts in prices. LTCM had heavily bet on Russian bonds and similar investments, believing that their prices would remain stable. But instead of converging, as LTCM's models predicted, prices diverged sharply. The small inefficiencies they had bet on became massive gaps, causing their trades to move violently in the wrong direction. At first, the losses seemed manageable, but as panic spread, LTCM's positions suffered even more. In a single month, the firm lost nearly $1.9 billion. The losses continued to mount, and soon, the fund had lost over $4 billion. LTCM had borrowed so much money that it was now dangerously close to bankruptcy. The Federal Reserve steps in. LTCM's collapse was not just a problem for its investors. It posed a systemic risk to the entire financial system. Because the firm had borrowed money from nearly every major bank in the world, its failure could trigger a chain reaction that might cause global markets to crash. Fearing a financial catastrophe, the Federal Reserve intervened. In September 1998, the Fed called an emergency meeting with 14 of the world's largest banks, including Goldman Sachs, Merrill Lynch, and J.P. Morgan. The banks were told that if LTCM failed, they could lose billions and destabilize the entire financial system. After intense negotiations, the banks agreed to bail out LTCM with a $3.6 billion rescue package. In return, LTCM's managers lost control of the fund, and the banks took over its operations. This intervention prevented a broader crisis, but it was a shocking moment in financial history. A single hedge fund had nearly brought down the global economy. The aftermath. LTCM's failure exposed several critical flaws in the financial system. 1. Overconfidence in mathematical models. LTCM's founders believed their models could predict the future with certainty. They failed to account for unexpected events and human emotions in financial markets. 2. The dangers of leverage. Borrowing money can amplify profits, but it also magnifies losses. LTCM's heavy use of leverage turned a manageable downturn into a catastrophic collapse. 3. Systemic risk in finance. The failure of one firm can threaten the entire financial system, as LTCM's collapse nearly did. 4. History repeats itself. Despite the lessons from LTCM, the financial world continued to take excessive risks. Just a decade later, in 2008, an even bigger crisis occurred. The global financial crisis, triggered by reckless trading and excessive leverage. Conclusion. Roger Lowenstein's When Genius Failed is a cautionary tale of hubris, risk, and the limits of human knowledge. LTCM's founders believed they had built a perfect system, yet they failed spectacularly. Their story serves as a reminder that markets are unpredictable and that no one, no matter how intelligent, is immune from failure. Despite its collapse, LTCM's story remains relevant today. It highlights the fragility of financial markets, the dangers of over-reliance on complex models, and the risks of unchecked greed and overconfidence. The book is a must-read for anyone who wants to understand why financial crises happen and why they keep repeating throughout history.